Current asset is an item on an entity's balance sheet that it is either cash, a cash equivalent, or which can be converted into cash within 1 year. Some examples are prepaid expenses, accounts receivable, or inventory. These items are typically presented in the balance sheet in the order of liquidity, which means that the most liquid items are shown first. Merchandise inventory is the cost of goods on hand and available for sale at any given time. To determine the cost of goods sold in a accounting period, management needs inventory information. Management must know its cost of goods on hand at the start of the period, the net cost of purchases during the period, and the cost of goods on hand at the close of the period. There are different types of inventories. Merchandise, goods that a company buys and sells without changing in their basic form. Raw materials, resources in stock and available for use. Work in progress, products started but not yet completed. And finished goods, products manufactured by the company, completed and ready for sale.
Now we move on to the purchases of merchandise. The purchases account is an expense, so has debit balance. In order to calculate net purchases, we need to multiply the number of units by the unitary cost, plus all the costs necessary to get the merchandise ready, minus the discounts included in the invoice. The initial valuation of merchandise comes from the ending valuation of merchandise from the prior period. The beginning inventory is a current asset, so it has debit balance. This account shows the amount of beginning inventory during the whole period. There are two types of discounts: the discounts inside the invoice that decrease the cost of gross purchases, and the discounts outside the invoice that decrease the cost of net purchases in the income statement. The discounts outside the invoice are contra expenses accounts, and we have some examples, like the volume discounts on purchases or rappels on purchases, the purchases returns, and the prompt payment discounts on purchases.
Regarding the sales of merchandise, when registering a sale, in the debit side we always have to record an asset as the company receives cash, or accounts receivable if the company sells on credit, and in the credit side a revenue account which is merchandise sold. And the company can also incur some additional cost, make discounts to customers such as rappels, prompt payment discounts, and sales returns, which are all contra revenues and are recorded in the debit side. Next, regarding the ending valuation of merchandise and the cost of goods sold, the difficulty comes when the company sells identical products at different prices, and the most important methods to calculate the value of the ending inventory are the weighted average cost method and the first in, first out method, and here we can see an example. Through the weighted average cost method, to calculate the cost of goods sold, we multiply the number of units sold by the weighted average cost per unit. And finally, the ending inventory is calculated by multiplying the number of units left by the weighted average cost per unit value. And under the first in, first out method, we assume that the earliest units in the inventory are the first units to be sold. And in this case, as the company sells 250 units and the first units registered in the company are the ones from January and March, we must take these units and multiply them by their value. And finally, the ending inventory is calculated by multiplying the number of units left from each month by their value.
Regarding how impairment works for merchandise, impairment is basically an estimated or potential loss that a company's merchandise can suffer, and merchandise is considered impaired when the amount shown in the balance sheet can't be recovered by selling it. Merchandise is valued at the end of the period by comparing its cost to its market value. If the cost is larger than the market value, we record the estimated loss, but if the cost is smaller than the market value, we don't record the estimated profit. There are two entries that need to be recorded in the accounting books: the impairment of the current period, and in the next period, the reversal of the impairment from the previous year, and a new impairment for the new period if necessary. Value-added tax, or VAT for short, is a European consumption tax. Basically, companies pay in advance the VAT when buying goods and services and recover it through sales. Input VAT is an asset and it is recorded on the debit side. Output VAT is a liability and it is recorded on the credit side. VAT payable is a liability and VAT receivable is an asset. And the difference between the output VAT and the input VAT is paid to the tax office.
Now we are going to talk about receivables. They can be defined as a right to receive cash in the future from a current transaction, for example, sales. That means that there is no cash flow movement at the beginning. There are two types of receivable accounts. The account 430, that is called trade receivables, that the transaction refers to the main activity of the company, for example, sales or service rendered, and account 431, trade receivables and trade bill receivable. That is the same, but is when it is formalized in a bill of exchange payment or a promissory note. The only difference between these two is the document in which they are formalized. The trade receivables are written in invoices, and the other ones are written in notes that represent a stronger commitment of paying. It's also important to talk about there are two types of valuation of receivables, that is the initial valuation and the post-evaluation. Then the impairment of receivables is also important, and it happens when certain portion of those receivables will never be collected. They can be calculated, and there are two methods to register: the individual allowance method and the global allowance method.